Hello, chart watchers, and welcome to this Tuesday, February 6th, Market Watchers Live Show with your hosts, Tom Bowley and Aaron Swinland. For those of you just joining us today for the first time, welcome to the show. And for our regulars, welcome back. Very interesting times in the stock market right now. Let's take a look at what's going on today. It's been a wild roller coaster ride. Currently, we got the Dow Jones Industrial Average down 16 points. Not too bad. The S&P 500 also just below the flat line. Nasdaq, again, just below the flat line, down 11 points. And the Russell 2000 down 6. But you can see in each instance, we did actually go lower than we went yesterday. So we did put in a lower low. Market's still struggling to rally back. It's going to be an interesting afternoon, no doubt. The 10-year Treasury yield has dipped. We saw the 10-year Treasury yield, the TNX, falling in the second half of yesterday's session. That is continuing today, with the TNX down over 4 basis points today. Volatility continues to be on the rise, and this is what makes me nervous. Anytime you get the volatility index rising like this, we can see very swift declines. We saw that yesterday afternoon over about a 60, 70-minute period where we saw the Dow Jones drop about 1,200 points. That's always a problem when we've got this kind of a market environment and the market anticipating high volatility ahead. The XLB and the XLY, two of the better performing sectors today. You can see currently both of them are in positive territory. Automobiles having a pretty good day today on the back of GM's earnings. You can see GM shot out of the gate earlier today, has pulled back some, and that's caused the autos to sell off a bit, but they do still remain among the best industry groups. Travel and tourism also having a strong day. Note both of these two industry groups are within that consumer discretionary area that is performing well today. And one of the key components, and one worth watching, is Priceline. Priceline seasonally loves this period, this time of the year, and after gapping down this morning, it is trying to rally back. So with that, we got a lot to talk about today, but let me bring in my co-host, Aaron. How are you doing this morning, Aaron? Make sure you're unmuted. Can't hear you.
It's a beautiful morning here in California. I'm very much enjoying it today. So,
yeah, the weather here still, kind of, it's better than it was. We're not freezing, but we're certainly not seeing 60, 70-degree days either. So it's kind of, I don't know, it's not nearly as bad as the market. The weather conditions in the market have been pretty good.
Right. Yeah, it's been pretty nerve-wracking, I would say, for a lot of us. And, keep waiting for that bounce. And, well, not seeing it just yet. I'm still looking for a short-term bounce, but we're just not there yet. Maybe we're bottoming right now with the market mostly unchanged right now. So we'll have to see.
Yeah, the interesting part was yesterday afternoon, about 2 o'clock is when we started to see the market really sell off big. That's when the Dow went from down 300 to down 1,500. It lost 1,200 points in about an hour.
And yeah, we went off the air and it went crazy.
Yeah, it did. It rallied back almost 900 points in 20 minutes. I mean, it was crazy, and then started selling off again into the close, which is never a good sign. And then last night, the futures were all over the place, down big, came back, went green, and then, of course, opened up a little bit on the red side. But we put in that lower low today, and that still has me a little concerned. But we'll get to all that in just a couple minutes. I know we got a bunch going on today, and so I'll let you get into the announcements and today's agenda.
Sure thing. All right. So upcoming tomorrow, we have Gordon Scott from Investopedia. He was also one of the CMT education coordinators. And Thursday is Arthur Hill. He's going to come in for a short segment. But if we know Arthur, he'll probably stick around for more of the show than just his small segment in the beginning. So that'll be a treat. And as far as today's agenda goes, we have Bill Shelby here from StockCharts to talk about everything StockCharts. And we're going to do a segment called Cause and Effect that should be very interesting for you, followed by the 10 and 10 to 1, where our first symbol is going to be Universal Display, OLED. So if you want to go take notes on that. And finally, we have a very interesting agree or disagree statement. So stick around for that.
All right, sounds good.
And I know there's lots of technical news, so
Yeah, we got a lot of technical news, not a whole lot of economic news, though, today. This is actually very light. There was no significant economic reports out today, and that can be a good thing or a bad thing. Usually when the market is selling off like this, it's a bad thing because we need something you need some good news, something maybe to encourage some buyers out there. And when we don't really have any news, any economic news, then it all falls onto the earnings reports and, of course, the charts. And what a lot of folks are looking at right now are charts that have just completely broken down. I always point to technical analysis being, the end all be all for, trading, that you want to follow the charts. But the problem is when you get a market like we've had the past couple of days where the volatility index shoots up into the stratosphere, you notice a lot of these support levels act like like they're not even there. And one thing I always refer to is when you get into these periods where there's a lot of fear and panic and the expected volatility or the volatility index, the VIX, starts rising. I always refer to this as a period where market makers go on vacation. Their role in the market is to provide liquidity, and they do that in normal markets. But when the market sells off, they kind of just disappear. And if you think about it, I mean, they do have limited capital. And when everybody starts to sell, the last thing they want to do is start putting their capital to work during a free fall. So in my opinion, that's why we see these huge drops in relatively short periods, because all of a sudden that liquidity that the market is used to is no longer there. And all these price support levels and trend line support and moving average support, I mean, we get those broken just like, hot knife through butter. And unfortunately, that's what we've been looking at. And the most interesting thing to me is the timing of this all happening. Normally, it doesn't happen this time of the calendar month. I mean, if you look at the 10-year Treasury yield, we have been seeing the 10-year Treasury yield, although the last couple of days we've pulled back, but we've been going higher. And so that means that money is selling, or that the money is coming out of the bond market. We're seeing a lot of selling in the bond market, which means there is money to be invested in stocks. And then you also have what typically is the anticipation of money flows. So normally we have the stock market going up at the end of the month, and then the money flows come in, and you have, markets continuing to go up. So when you look at what's been happening here over the past few days, we've got money flows that are coming in. I mean, I'm sure everybody's still contributing to their 401ks, and that money is hitting the Fidelities and Vanguards of the world, and that money has to be invested. They don't, these types of firms don't make decisions on behalf of you. They follow your instructions, which is to invest in various funds. So you've got all these other funds out there and financial firms that are investing money. You've got money coming out of the bond market, well, except for maybe the last 2 days. You had money coming out of the bond market, available to go in the stock market. And yet what we've been watching is the S&P 500, and let me pull this up for you. But if you look at the S&P 500, it has been doing nothing but going down. Now, it is temporarily halted. Well, not halted as in not trading, but the slide has been temporarily halted just because we did gap down. We went lower earlier today, but we've come back. And we're sitting on the S&P down 6 points, which is a pretty darn quiet day compared to what we've seen the last couple of days. But it is still in an intraday state. This isn't the close, and we could see a lot of craziness between now and 4 o'clock Eastern time. I mentioned earlier, I don't like the fact that we put in a new low. And I think with this, unfortunately, we also put in a new high on the volatility index. I'm going to talk about the VIX a little bit more during the cause and effect segment later. But you can see that the VIX actually got up as high as 50 intraday. At least that's what it's printing here. It doesn't really show it on the chart. So it must have been a very, very quick move to the upside and back down. But we're still sitting right now at 34, a very elevated level. But anything in the 40 to 50 range is a pretty historic number on the volatility index. And again, I'll talk about that a little bit later. But at least in the short term, we are seeing the volatility continue to creep up. Even though we've pulled back here in maybe the last 30 minutes or so, it does continue to creep up, continues to print higher highs, and we're seeing the S&P 500 continue to print lower lows. So this afternoon, like I said, still could be full of fireworks. We're going to have to watch this pretty closely. Now, looking at the overall indices, technically, and again, it's very difficult. I mean, look how quickly the Dow went back through its 20 and 50-day moving average. It was like it wasn't even there. And the volume accelerated. So you're getting this panicked sell-off with very high VIX readings. And technical analysis, in my opinion, really, if you're trying to buy stocks on a 20-day test or a 50-day test, you're finding out they're just not working. And part of it is that market makers who also trade based on technicals aren't buying, not at least at the rate that you would expect on these pullbacks. So, but again, it's the fear factor that's out there right now, and we go through these periods occasionally. And when we do, it just unfortunately, it's a period where prices tend to drop very rapidly. And yesterday afternoon was a perfect example of that. But looking at the chart, here is the daily chart. I mean, I see obviously a lot of technical damage being done here, high volume breakdowns of key support levels. I go out to the weekly chart, which I think is more important. And right now we're trying to hold on to that rising 20-week moving average. I mean, if you got a really strong stomach, you could maybe take a shot on this 20-week test, but I would certainly be keeping my stops in play, especially if today's earlier low gets taken out. Could be a very quick reversal and a very quick stop out. So you have to be alerted. What I'd feel best about is if we see the VIX start to relax later this week and we have a nice reversing candle on this 20-week test. But it's awfully early in the week still. Very difficult to say where this is going to end up come Friday afternoon. So the Dow is testing that 20-week, and I'm going to focus on the weekly chart here as I go through these other indices. First, the S&P 500. Again, you can see us trading just beneath the 20-week moving average. Currently, that is at 26.62, and the price is on the S&P is 26.44. So 18 points below, and as rapidly as the market's moving, that certainly may not be a problem if the market begins to rally again, but that's a big if. The Nasdaq, pull up the Nasdaq on the weekly chart, and you can see right now we are holding that rising 20-week moving average. And we might look at this 6 months from now and look at it just like we looked at these other pullbacks as an opportunity to get in on the 20-week test. The problem is with the heavy volume and the huge spike in volatility, the risk of getting in on this test is a lot greater than these prior tests. And so that's what you have to be willing to deal with. And finally, the Russell 2000. This has been the weakest index. You can see the 20-week moving average has been lost. That is up at 1521, and we're currently at 1487. So we would need to see roughly a 2 to 2.5% rally by Friday to hold on to this rising 20-week moving average on the close. Among the sectors, in my opinion, consumer discretionary is still by far the best industry group. I think that when you look at the daily chart, you say, well, it's been breaking down. But currently it has rallied back up. We got a nice hollow candle today so far. It is above the 50-day moving average, which not all the other indices can claim that, or the other sectors, I should say. And if we move to a weekly chart on the XLY, we didn't even get a 20-week test yet. So you can see that the XLY is performing much better than the S&P 500. And another way to look at that is by taking the XLY and putting a colon $ SPX. So this will give you a ratio. I'm going to get rid of the candlesticks. And what you see is a sector that is absolutely exploding relative to the S&P. So we've been seeing consumer discretionary come down just like every other area of the market. But on a relative basis, it's doing much better than the S&P 500. And I actually take some bullishness out of that because normally when a market is selling off, you see the aggressive indices or the aggressive sectors selling off harder than the benchmark S&P 500. But in this case, we're actually seeing it outperform, and we have a relative breakout. If you go back over the last 2 years, we've talked about this a lot in the past several weeks, but we had a sideways consolidation period for almost 2 years. It looked like we were breaking down out of it, and now we have just taken off to the upside. So the XLY, I think, looks really interesting. And a few areas within the XLY, one is the home builders, the XHB. This is one of the better performing industry groups today. The XHB, on a relative basis, you can see it's definitely pulled back, but we remain in a very steep uptrend over the course of the past 14 or 15 months in home construction. So I would not be surprised to see this group begin to outperform again, especially if the market gets its legs under it. So we'll have to kind of watch to see if we get a reversal in the overall market. If so, I would expect that the XHB is going to continue to perform pretty well. The XRT, this is the retail group, another big key space within consumer discretionary. And this group was on fire at the end of 2017 and into the first half of January 2018. You can see we got right up to a key relative area. We have pulled back, but again, I think this could be setting up a pretty nice opportunity. Keep in mind that from a seasonal perspective, retail loves February through April. So this is a group, again, if the market can get its legs under it, I would look for a bounce back in the XRT, especially given the fact that money has been rotating on a relative basis towards the consumer discretionary area of the market. Couple of individual stocks. First, Lennar. This is a home builder. So I just talked about the home builders, and you can see a very interesting bullish engulfing candle on the daily chart right now on Lennar. And I think if we go to a weekly chart, you will see also a nice hammer forming after we got all the way back down, essentially to test a key price support area. So Lennar is a pretty interesting stock within that home building space. I mentioned the retailers. I think Jcpenney looks interesting here. Now, this is one that's been on a downtrend for quite some time, but I think this pullback here could be establishing a reverse right shoulder. So we've been coming down. This looks like it could be a left shoulder. This is a left side of the neckline. Here's your lower low for the reverse head. Here is the right side of the neckline. We come back down into what could be a right shoulder. I'd be interested if this stock got back up above that 20-week moving average. It'd be worth taking a look at after a very lengthy downtrend. Jcpenney could benefit from money moving back into the retail area. With that, I know we've got some upgrades and downgrades before we bring Bill Shelby in for everything stock chart. So I'm going to pass over the upgrades and downgrades there and take it away.
All righty. Let me get my screen up here for you.
Couple big earnings reports, well, especially one tonight I might as well mention is Disney. Disney reports after the bell tonight. That's going to be a big one. And Gilead Sciences, GILD, in the biotech space. So you might want to keep an eye on those after the bell.
All righty. Yeah, I'm still having trouble here. Taking time. It's so strange because this never happens to me when we're not on air. But, you know.
I'll show the M chart because this is actually a pretty big chart for the autos.
I'll get it.
Yeah, we had broken down here. You can see this double bottom that had come in at about 40.5 to 41. We broke below that yesterday. We're trying to get back up through. And I mentioned that the autos had been doing, at least are trying to hold on support. And I think that GM and how it performs the rest of the day and the rest of this week could have a big impact on the autos as a whole.
All righty. So here we go. I finally was able to get my screen up here. So the first one I was going to look at was we got an upgrade for Micron. And actually, of all of these, I thought this one looked interesting. I know everybody says, what is interesting? Well, it's interesting. I'm noticing that the PMO is actually starting to turn up here right while the price is coming off of the bottom of this trading range, which has stretched all the way up here to 47.50. I like the scooter looks pretty good here still too. So we're getting a bounce off of that support line, and there are various areas of overhead resistance between now and then. But the fact that we're starting to see in oversold territory a bit of a bottom on the PMO, I think is positive. We had two downgrades, and we're going to look at Core Logic first. And it looks similar to the market lately with these falling off a cliff waterfall decline here. Obviously, that's taken out the PMO and put a sell signal in place, but everything else is not looking so great. I think the good news is I think we are in an area where we could find a lot of support for Core Logic, and we're testing it right now. And I think this is what's going to be interesting overall in the market, just to see where all these levels are as far as support and what's actually happening with it. And I'm finding that when I look at a lot of the stocks, they've had these declines, but they're all coming right at previous support. The November support areas are a popular spot. So I think you've got another area of support. So even if we don't, even if it does end up falling below this, but you can see the bounce already if I looked at an intraday chart. which I happen to have right here. So you can see it was a really rough morning, but we've already made some strides back up. Could be a little bit of a flag formation today. So this could end up being the bottom for CoreLogic here, but it did get a downgrade. So you might want to watch that one for just a bit longer. ExxonMobil also was downgraded, and of course, I believe the oil producers, oil services, they've been having a really rough time of it. And I know you talked about Chevron, I think, yesterday, Tom, but we're seeing similar movement here for ExxonMobil, really difficult decline. But again, we're starting to see some support here. And I've logged it because of all of these bottoms that connect with this support area from earlier from mid-year 2017. So I see this as a pretty good area of support, but you can see the intraday low already had passed on below that, but I think there's a pretty strong support sitting here at about 75. I'm going to show you the intraday chart real quick here, and then we'll get Bill on here. So you can see, unlike we were looking at Micron, we're still in the middle of this decline. We're really not getting a true bottom, I would say, at this point. The fact that we didn't hold this area right here at 78 would worry me a bit, and now it's acting as overhead resistance. So ExxonMobil probably not out of the woods just yet.
And I think Exxon and Chevron, they had to have been two of the worst earnings reports I've seen during this earnings season. I mean, they just both came way short on bottom line. I know Exxon missed on top line as well, and I think maybe Chevron did as well, but they were not very good reports, especially given that both were trading pretty well heading into their earnings reports, and they look good technically. I think it threw the market for a loop, and I think that's why these two stocks have taken such a big hit during this decline.
I have to agree with you. So with that, I think we should bring in Bill. I know he's waiting patiently in the wings to talk to you. Hello, Bill. How are you doing this morning?
Good. And you?
I'm doing quite well. It's always interesting when things are actually happening in the market, and let's face it, there's a lot happening right now.
Yes, it is an interesting time to look at things. It's a little bit scary. It's certainly a Pepto-Bismol sort of market.
Exactly.
Yeah, actually, Bill, do you trade more short term or more position trade? I mean, what does a market like this do for you? I mean, do you routinely get stopped out and just wait on the sidelines, or are you trying to look for opportunities? I mean, how do you approach it?
Yeah, this is where some of the more peripheral things that aren't really my core, I would sort of take that money off the table. I sold out of a few things, over the last couple of days that were sort of my experimental or things that I would sort of tend to hold on for. I would say more position. I would hold things for weeks to months as opposed to days. Mm-hmm. I just don't have the time to stay on top of things, given the work schedule. Mm-hmm. So I would hold things on a longer time frame. But this sort of market, I would maybe cut some of my more experimental things, or things that I know that I'm really sort of in for as long as they continue to be a sort of a momentum trade. Mm-hmm. Once they get a little wobbly, I'll head out. But I'm hoping, and I sort of expected, Tom, we were talking about this last couple of times I was on, about the fact that we had a couple of months there where we did 1,000 points in a month, or even a few weeks, multiple times. And at some point, obviously there's going to be a snap back to the mean. So after seeing a couple of months of those 1,000-point gains, this is not unexpected. And at some point it was going to have to happen. So like I'm saying, now we're just hoping that we'll sort of see a basing start to form here. We won't continue to see a rapid deterioration.
Yeah, but even as strong as it was for the last several months, I mean, it took 3 to 4 weeks to go 1,000 points. It takes like 40 minutes to lose 1,000.
Yes. Well, the other thing as well is that Grayson and I talk about this, is that on a percentage basis, 1,000, 1,200 points is obviously a large number. But we start to get these higher and higher values of the Dow and everything else on a percentage scale. Sometimes it's not as much. There were some friends I was talking to say, well, the Dow went down 200 points or something. But it's like, yeah, but from 26,000, that's on a percentage basis, it's not that big a deal. It's just that the number has gotten so high. And historically, we're used to the Dow at, obviously lower numbers, so that a 300 or 400 point is the number we think of. We think, well, 400 points at 16,000 was a much bigger deal. So I try to keep my eye on the percentage as opposed to the number, especially as these numbers get bigger and bigger.
Mm-hmm. Well, and you look at a bear market, which typically lasts much less time than a bull market. I mean, a bear market that went in 2000 to 2002, we went just a couple of years, and then the one in 2007, it was really October 2007 to March 2009. So you're talking about a year and a half. But the percentage and the points that dropped during those periods is what's so alarming, and so it makes it so fearful because these drops are so much faster to the downside than the upside. And you can break that down into a daily chart as well. And like I was saying, yesterday afternoon, the Dow was down, I think it went down like 1,200 points in just a little over an hour. And when we look back at the history to see how long it takes to go up, 1,200 points at a time, you might have a week where you have that kind of a gain, but usually it's over, 3-4 weeks to try to generate that kind of gain. It's just a pretty scary thing to lose it in an hour. But
it's that whole catching a falling knife. I mean, that's a pretty accurate
yes.
portrayal of these sort of moments you see. Like yesterday, I a couple of times yesterday, I was of course looking at the homepage and looking at the totals, and it was down 600, down 7, down 9. I'm going to stop refreshing now.
I actually had my charts on that 60-second refresh.
Right.
And time it would refresh, I'd get that another long drop in the bar because I had a 1-minute chart up, or maybe it was a 5-minute chart, and that each 5-minute bar was just growing exponentially each minute. And that's the thing. I mean, if you're trying to trade and manage risk, it's really difficult to do that when the market's dropping like that and the volatility index is going through the roof. I mean, that's telling you that the market's anticipating a lot more whipsaw action and a lot of volatility. And that's exactly the opposite of what you want, at least what I want in a market. I want low volatility and low risk. So anyway, we go on, and it's an interesting discussion, but I know you've got some seasonality stuff to talk to us about. Why don't you go ahead?
Yeah, well, we'll talk about seasonality. I know you've talked about seasonality quite a bit, and I know some people probably seen our seasonality tool, but I thought I would just go over it for those who might not have seen it, and maybe throw in a couple of ideas of how we might use the seasonality tool a little bit differently than what's sort of the obvious mode. So we're going to just sort of go over some of the elements of the UI and how we can use a relative seasonality, and then maybe a couple little tips and tricks on how to use something slightly different. So there's a couple ways to get to seasonality. This is our members dashboard. We can look at seasonality on any of our chart lists. So I can just go down and say, well, I'll go down and look at seasonality. And this allows us to scroll through all of our items in the chart list. I'll be going over the UI here in a second. I just thought I would show this is the members version of this that allows the chart list view. What I will probably do, since I'm going to jump around and look at some symbols that aren't necessarily in some of my saved chart lists, I'm going to go to the free version. We can go over here to our control center, scroll down, and hit seasonality. This is essentially the same thing, except we can change our symbols. I just was, before the show, just sort of arbitrarily decided to play with airlines today. I have no idea why. So I'm just going to start with one of our Seattle airlines here, Alaska. And just to go over the UI a bit, this is the histogram mode. This is the most common mode that people typically use for seasonality. And this shows a 5-year range. And it says basically, what are the percentage of times where the opening price of a given month is higher than the closing price? Or excuse me, the other way around. The number of times that the stock has gone up in the month. So we can see here in January, over the last 5 years, Alaska Airlines has gone up 60% of the time. And this little number down at the bottom of the bar is the percentage of the gain for that month. So we can see, obviously, Alaska over the last 5 years has a fairly predictable seasonality in that sort of mid-summer, it's kind of flat, but then end of the year takes off. It's pardon the pun. So if we were going to try and play this to our advantage, we would say, well, maybe I would look for a dip sometime in October, maybe early October, since we're 50% of the time we got about a 3% gain. So maybe even end of September, I would maybe look for a dip and basically hope to ride it all the way through the winter season here. And maybe sometime in March, I would try and get out, because April, we look like we have a pretty low seasonality rate, down 6.1% on average. So I would say, okay, maybe I'll look to hold this from September till March or April, which of course is sort of generally the best seasonality for the market itself. So that's another way to look at Alaska. We've got a couple other views we can look at. We can go over here to the separate views, and this is just basically a yearly chart of each year that's displayed. Now, we've said we're looking at 5 years here, but it's useful to note that the current year, the last year, is a partial year. So we're really looking at full 4 years and a very small part of this year. So if you want to, it's just something to be aware of, that as the year progresses, this 2018 will slowly factor in each successive month. If you wanted to make sure you got a full 5 years, you would have to necessarily stretch it out further to go back another previous year. We can turn off a particular year or turn it on by clicking on our years up here. We can take this window and slide it across time. Our next view is the same scale. So this takes all of them and puts them similar to a performance chart, a perf chart. If you've seen the perf chart, this will be a similar display. The perf chart, we of course take multiple symbols and look at them across time, whereas here we're taking a single symbol and splitting it into years and looking at it. So we can see particular good years or bad years. And this will show us a little bit more of the volatility and the variance that happens. The histogram, of course, gives us just a block view without any sort of idea of how much this particular stock might be swinging. This separate view, it's the same scale view, will also show us how much variance and volatility we're getting. And if we don't want to have a particular year, we can take that year off as well just by clicking. Sometimes we'll click on one that's at the edge and we'll see a small adjustment as it recalculates the range. So we can see that a few years here we had some fantastic performance out of Alaska. A couple of different years up 60 some odd %. And we had just 1 year out of this batch that wasn't particularly great. And that was actually last year. So we'll go back to our histogram mode, and we can go out to about 20 years. And we'll get this back. So another thing you can do is the comparison. I know Tom likes to look at things, how well a sector performs relative to the S&P or whatever. We can also look at this to see maybe there's some interesting things we can find out about performance relative to our peers. So how does Alaska do against other airlines? Is that it may be interesting. Maybe we can find something there. So this is Southwest. Just picked another random one. We can see that about half the time it outperforms Southwest. Another half the time it doesn't. So Alaska isn't clearly consistently beating Southwest. So maybe we can look at a couple others. United Airlines, it seems like we're beating United a little bit more. We're seeing more bars above 50%. So it means we're more consistently beating United. Delta, about the same. When you take some of these 25s, might take out our 100 here, although it's interesting that if Alaska always outperforms Delta in March, we maybe see that March is a historically bad month for Delta, whereas we saw that it was into about April before things sort of turned around to the downside for Alaska. Maybe JetBlue, and that looks pretty neck and neck. If you just average that out, it's about a 50-50 shot. So this is another tool. So maybe if we're looking at airlines and we're sort of trying to decide, well, which one of the airlines do I want, we can go here. And I wouldn't necessarily use this as the only thing I would look at, because obviously, as Tom's talks about his vast research on seasonality, you don't just do it today every time because it's historically happened. It's just a tendency. But if you see evidence that this is sort of a consistent behavior over a larger period of time, it's something that might tip me a little bit towards one option than another. And the final sort of idea that's I use sometime is to look at the actual industry group. So we'll go here and look at airlines in general. And then what I'll do is run my actual airline that I'm looking at. This is sort of say, does my airline that I'm looking at have any consistent outperformance over its peers? In other words, is one of these sort of consistently better, rises above the rest of the group, the rest of the pack? So I'll run through this as well sometimes and just sort of see. Alaska looks pretty good. It's above the 50% mark most of the time. Let's run through some of our others. JetBlue, not quite so. Or sorry, that's Southwest. Delta looks like it holds in there pretty well. United's about average, I guess. And there's our JetBlue. So it's just another tool to sort of say, maybe we can find this is our sort of best in breed. We can see if there's anything that is consistently above its peers. And again, this is sort of, I just look at this as sort of icing on the cake. If I've got some other historic perf charts where I see, maybe I'll put all the airlines on a perf chart and see which ones have outperformed. But this sort of just can give us, if you are a short-term trader and you're thinking, I'm looking to hold this thing for 3 or 4 months, seasonality can be a useful thing because there are definite trends where something will be relatively strong or weak over a shorter time period like that. So that's how I can tend to use seasonality in sort of a way that's not as common if you just look at the tool itself. And that's it.
Awesome, Bill. Yeah, the seasonality, there was a question that came in the chat room I was just getting ready to respond to, asking about, do I look at the nearest years when you consider seasonality or all available periods? And I know you just touched on that a couple minutes ago, Bill, but for me, being somebody who's really interested in math and so forth and statistics, the more information you have, the better. I mean, if I look back, and I did an article in Chart Watchers last weekend talking about the Nasdaq 100 stocks on a seasonal basis, trying to identify stocks within the Nasdaq 100 that perform well the next few months. And part of that exercise, I eliminated stocks that had less than 10 years of history, just because to me, it's, one of the stocks on the list, I think, was JD.com, and it was very volatile on a seasonal chart, because it only had 4 years of history, or maybe 5 years worth of history. Right. And so you can get a lot of, you have one really bad month one year, and the next 3 or 4 years, it's difficult really to make up for that. So I would say, number one, the more data, the better. And then number two, I like to see periods of strength. So not just 1 month here or 1 month there, but for instance, I know, and maybe you can pull up the XRT, Bill.
On the basic chart?
Yeah, the seasonal chart.
Okay.
And then drag it 20 years. Yeah.
Silly browser.
And then just drag it. Well, it goes back 13 years. Maybe I have to use another. But you see my point is February, March, April, you see the 75%, 73%, 73%. So, and it sticks out above all other months. To me, that's telling me that there is a seasonal period, not just 1 month, but a little bit longer, where the XRT retail tends to do really well. And if you look down at the average returns during those 3 months, those are the best 3 months. Those are the best 3 consecutive months of the year as well, when you're looking at average monthly returns. Another one, and maybe we can kind of wrap it up on this one, but another one is Priceline, PCLN. And again, I think it doesn't want to recognize you taking out that XRT.
I know. And
drag that one back. I mean, this is probably the most amazing seasonal chart that I've seen. And you can see that January 47%, and then February, March, April, you can see that the bars, the really high bars, 79, almost 80%, down to about 68% in March. Priceline goes up most of the time, February, March, and April. And if you look at those average returns over the last 20 years, those are average returns in each of those calendar months. 5 or 6% January, February 8%, March 8%, April 13%. Those are consecutive periods. So I remember writing a Don't Ignore This Chart blog article last year. It was probably around August. And Priceline, of course, doesn't do nearly as well in the last few months of the year as it does in the first, 3, 4, 5 months. So I had written an article there to be careful and maybe look at getting back into Priceline from a seasonal perspective at the end of December because of these gains that we tend to see in the first 4 months. So again, for me, it's about having that full 20 years worth of data and then also seeing a period of time, not just 1 month. You know, if a stock does great 1 month and it's weak the next, then great the next, then weak the next, that doesn't really do much for me. But when I see a period of time like you see here with Priceline, to me, that's just telling us that for whatever reason, and we could guess as to the fundamental reasons, maybe it's everyone anticipating, you know, what's going to happen over the summer with all the travel and everything. Maybe that's why Priceline does it. But this is something that's notable to me. And so if I see a chart, if I see the Priceline chart looking very bullish, which by the way, on a weekly chart right now, it's got a nice inverse head and shoulder continuation pattern. And I know seasonally that it does well. I'm watching this stock like a hawk for a potential breakout. So that's how I use seasonality. I don't use it as my go-to, but I'm aware of these different seasonal tendencies. And then I look to the charts to, you know, knowing that I've got this confirmation if I see a breakout technically.
Yeah, exactly. It's not something I would base an entire trading decision on, but it is an interesting sort of, as Gaddis Rose puts it, you know, the wind at your back. You know, it's just another thing that increases probability that this is going to be a winning trade. And you were talking about getting all the data possible, and one of the things I was thinking about when I was doing the airline and looking at the 4 or 5 years or 6 years is sometimes if you're looking at group, and the one I picked happens to fall into this area of, it may be that the time period you're looking at is inconsistent over longer periods, because for example, the airlines is highly tied to oil.
Yes.
Right. So you have to be sort of aware, is there something that's underlying here that would make the current 4 or 5 years completely different than 20 years ago? Now, maybe there are groups that aren't quite as sensitive to something like that. But I was thinking, as you were talking about getting as much data as possible, I was thinking, wow, the airlines, you know, maybe 5 years now is completely different than 5 years, you know, 10 years ago or whatever, because of maybe the group you're looking at is sensitive to oil or interest rates or some sort of external feature that you just kind of want to factor that in.
Yeah, I think, you know, and I've looked at this before. I think if you put in that the seasonality for the airlines and then compare it to the price of oil, the dollar WTIC, you got DL, US. Yeah, there you go. Yeah, and then compare it to the dollar WTIC. I think you're going to see in the fourth quarter that the airlines just swamp. I mean, that's the last 5 years, but you could drag that back, I think, the last couple of decades. And you can see that there's a clear seasonal pattern where the airlines in the fourth quarter just completely blow away the price of crude oil. And obviously, crude oil is going to have an impact on airlines. So anyway, there's a lot of interesting things that you can look at. But interesting stuff, Bill, no doubt.
All right. Thanks, guys.
All right. Appreciate you coming on. All right, let's keep it moving. We do have a new segment called Cause and Effect. Aaron, I know that you wanted to take a look at a couple of things. I do. You know, really what we're doing with this segment is we're just we're trying to focus on relationships in, say, the bond, the stock markets, you know, commodities, whatever, and how the performance of one area can influence the performance of another. So I'm not going to steal your thunder, but go ahead, Aaron, start it off.
All righty, I shall do that. So I thought I would start, I'm going to look at the dollar versus gold and that relationship. And I think it's a good cause and effect because I think some people mix them up a little bit, and I'll explain as we go forward. So first of all, I thought I'd look at the dollar chart just so we can see what's going on. Everybody wants to know what's going on. And I think we're in a good spot right now for the dollar, honestly, because I'm seeing that gap is filled. And look at the PMO, it's now turning up. And we're seeing a positive divergence forming on the OBV with price tops. So I think this might be the time. We might be seeing the dollar turn back up. And I'm going to show you gold. So right now we can see in the thumbnail, we've got the dollar's been rising slightly over the last week, I'd say. So let's look at gold very quickly. All right. And then if you look in the thumbnail, we can see we've been, you know, trending lower with gold somewhat. So we can see a new PMO sell signal. So if you recall, the dollar's getting ready to have a buy signal, and now we're looking at a sell signal coming up on gold. So I just wanted to point out, just so you can see sort of where they're going right now. But one of the relationships that is familiar, of course, is that we have to look at, you can't just look, gold is affected by the dollar and how well the dollar is doing, because it is given to us in the form of dollars for the price. So it is constantly being shifted and moved, not just by buyers and sellers, but also by what's happening with the dollar. And so there is a relationship there between the dollar and gold. And I'm going to show you a correlation between the two. So gold is in the brown here, and the dollar is in black in the OHLC bars. So I think just visually looking at this, you can tell me what you're seeing. It is a negative correlation. And remember, correlation is between 1, which is a perfect relationship. You go exactly opposite. And then we have -1, which is you go exactly together, or you go exactly opposite when you have a -1. You can adjust the periods for the correlation, and that does change the picture. I'm using 200-day average because I wanted to get a more long-term feel for what happens between the dollar and gold as far as the way they are correlated. And you can see typically it's negative. So they typically do move in opposite directions to each other. And that is because of that relationship between, the dollar, gold being expressed in dollars. So you have to pay attention to what's going on, not just with gold when you're looking at gold and the buying and selling, but you should pay attention to what's going on with the dollar. Now, I wanted to show you a what I would call a perfect relationship, and I don't know if I made the chart. Did I make the chart? Yes. So I'm going to look right here. We're just going to look at the top here. So this is the inverse S&P 500, and then this is the actual S&P 500. And this, of course, is a perfectly inverse relationship. So you can see you get all ones here on the bottom. -1. So they always travel opposite, because that's what that fund is meant to do. It's supposed to do the exact opposite of what the S&P 500 is doing. So one of the things that I think some can confuse, and I'll admit when I was first learning this, I confused it somewhat. I'm going to go back here to our correlation chart. But we're talking about cause and effect. So with gold, the cause a lot of times can be a strong dollar is going to weaken gold. So that's the effect of that strong dollar. But it doesn't go the other way. So if gold is strong and moving up, that doesn't mean that you're going to be seeing the dollar go down. It doesn't affect the other way around. So just because gold's doing well doesn't mean the dollar is weakening or is going to weaken. It's the relationship is the other way around. So that would be my main thing to cross through. But so there is that relationship between the dollar and gold, and you can adjust these correlations. There's a bunch of different things you can do, and I want to show you one that I just learned this morning because I was looking at it. You can look at your list. I'm going to show you my list right now, which has just some of the charts that I did for you guys earlier in these. But you can actually view a chart list as a correlation. And you can see how highly correlated what you're looking at is amongst each other. So if you're trying to diversify a portfolio, for example, you might want to look at how the various items are correlated. If you're trying to diversify, you don't necessarily want to pick two things that are highly correlated to the rest of your portfolio. Maybe you would rather have some that are running opposite as far as a hedge. And this is a way you can look at it, as far as you're figuring out how to diversify. So that's kind of a little extra that I'm going to throw in there as far as cause and effect and correlation. But my time is done. I want to look at some of your cause and effects.
Okay, let me quickly go through the VIX. I want to take a look first. This is a very similar chart similar to what Aaron was showing with the correlation. So you've got the S&P 500 here over the last 20 years. And then down at the bottom here, this is a weekly chart. It's just showing you that the volatility index, the correlation between the volatility index and the S&P 500 is almost always negative. And that's because fear drives the S&P 500 lower. And basically the VIX is the fear index. As the market begins to price options much, it basically is pricing the market to be more volatile so that the premiums on options begin to go up significantly. That's what drives the VIX higher. And at the same time, that's the kind of behavior, the volatility that drives the stock market lower. So I just want to point out, first of all, that normally what you're going to see is the VIX rising when the S&P 500 is going lower. Now, I did find it interesting that earlier in January, notice we started to get a little bit of a positive correlation. In other words, the VIX was rising early in January while the S&P 500 was also rising. I noticed, and I compared in my blog article this morning, the S&P and the VIX currently with how it looked back in 1998 in this period. Because if you think about all the spikes, and I'm going to show you another chart on the VIX in a minute, but most of the VIX spikes occurred during bear markets or just coming out of bear markets. And so the one in 1998, actually, the huge spike that we saw on the VIX in 1998 occurred during a very strong bull market. And it's not normal to see the VIX really explode because typically we see complacency in bull markets. We don't see big moves higher. But I did notice, and I didn't even notice it until just now, but I just noticed that prior to the weakness that we saw in 1998, we also had a very similar positive correlation start with the VIX and the S&P 500. So I don't know, maybe this is something to keep in mind for future bull markets. But with that rise, what it's telling us is the market's going up, but the market also is getting more fearful. Normally the market goes up and the market's complacent, could care less about the news. It just keeps chugging along. But as you see the VIX rise, it does make you feel like the market's getting a little bit more nervous and could be a little bit more sensitive to selling. And that's what we saw in 1998. That's what we're seeing here right now. The other thing I want to point out, and this was in my article, if you scroll down to the sector industry watch, I have the S&P 500 here going back these same 20 years. And I want you to take a look at where the VIX goes when we hit significant bottoms. Back in 1998, which is the period I was just talking about, we saw the VIX get up into the 40s. And you can see that over a period of a few weeks marked a bottom. And if you take a look at every one of these spikes, except perhaps that huge one in 2009 when we had the financial system meltdown, which I think is kind of a standalone case. And then perhaps this one time back in 2015 over the summer where we had one quick spike. Really, the 40s is an area to watch the VIX mark a bottom in the market, or at least that's where we start to see the VIX settle down. And so the movement that we've seen so far is pretty small compared to what we saw on a relative basis back then. And I've highlighted here in this red the period that, or the percentage decline that we saw in 1998. And I've taken that same shaded area and I've just put it up here because using this particular chart, I'm going to go ahead and get a live version here so that you can see down below. But if you go down here, I've got the log scale checked. And I prefer a log scale because to me, it's really about percentage moves more than it is about price moves. A price move, and I know Bill touched on this a little bit earlier, but a price move when you've got the S&P 500 up in the near 3,000 is much different than the price moves when you're back at 1,000. So I think it's much more beneficial to use a log scale so you can check the same percentages. So this distance from top to bottom on a percentage basis would be the same if we were to pull all the way back to 2,200 on the S&P 500. And we're sitting at 2,649 right now. I'm not making a prediction that that's where we're going, but based on the history, based on the similarities in the VIX and so forth, that could be in store during a bull market, and we would still be in a series of higher highs and higher lows. So in my blog, I just mentioned that this could be maybe a worst case scenario, in my opinion. I don't see it going down that far, and I certainly don't see it going down lower than that at this point. But when the market is this volatile, and you saw how quickly the Dow Jones lost 1,500 points, it is a potential that you need to be aware of. And I think you need to kind of determine how much risk you want to take in this market accordingly. So that was really what I had to share. I know we went a little bit over there, but I think these were both a couple of important charts and showing you how you can kind of tie one or the other, in with another area of the market. But I always look to the VIX. I think the VIX is really important because from a sentiment perspective, I mean, we can talk about fundamentals and we can talk about technicals. We can talk about seasonality, but there's really a psychological component to trading stocks. And I think when the VIX starts shooting up and spiking, it kind of supersedes sometimes technical analysis. We start seeing major breakdowns of key areas without so much as a bounce. And and it doesn't happen often, but when the VIX is at this level, I think we have to be really careful.
Yeah, I agree with you. The VIX is definitely something we need to pay attention to. And it's really interesting, seeing how, it does show fear. And that's one of the reasons I really like it as a sentiment indicator, because we are talking about fear factor and that sentiment. And typically you're going to see, a lot of bearish sentiment, a lot of worry generally does tend to come out of lead into those market bottoms when people are just really, really bearish. So.
Yeah, and panic selling. I mean, that establishes big bottoms. So I think right now what we're talking about is we have a very significant top now that's in. I'm not saying that is the final top. I'm just saying that is going to be a difficult level now to get through, given everything that's taken place, all the selling that's taken from that level, that's taken place from that level. And now we're just looking for where are we going to establish the bottom of the trading range. And I'm not sure that that's been established just yet.
Yeah, I agree. All right. Before we get in the 10 and 10, just wanted to remind everybody that ChartCon 2018 is coming up in August. It's going to be online, and you can find information at the link there or on the blogs page to the right. You'll find all the information you would like. But I just wanted that registration will be open for a while. But if you are interested in joining us for ChartCon 2018 in person, the VIP packages are only going to be available up until February 10th. So we're less than a week away from having to sign up and make that decision if you're going to join us just for the conference while we're in Seattle, or if you want to join us for the cruise to Alaska that is going to take place the week after ChartCon, and you can rub elbows with all of us crazy analysts at ChartCon or on the boat. Just don't push us over if you've had some bad calls from us.
Please.
I know, right? All right, so I'm going to quickly share the screen. I pulled up, I put in all of our, here. There we go. I put in all of the 10 and 10 requests. And I thought it would be interesting, since we were talking cause and effect and correlation, to do a view correlation-wise to the S&P 500. So we're going to correlate it with the S&P 500 just over the last 20 days. And as you can see, a lot of the stuff you guys are looking at are highly correlated to the S&P 500 right now. And so that, if the market, if we're not looking for that bottom just yet, these might not be the places to be if we're going to be following along with the market. And of course, there you go. The pro short is almost completely negatively correlated. Well, of course, it's an inverse fund. So that gives you a little bit more information there. So from there, though, I'm going to pass it back to you for our first one, which is going to be Universal Display, OLED.
All right, let's take a look. And I am going to do this lightning fast since we're a little slow. We're going to play a little catch up. I tell you what, though, I am sitting on my hands right now in the market. So if I say that something looks like it's at an interesting level or a solid support level, just keep in mind with a volatility index in the 30s or 40s that this is a level that could be taken out very quickly. So tough to be willing to take on the risks until you see the market establish a bottom. And so for me, I'm just going to kind of watch. But looking at OLED, I do think that we're getting a significant reversing candle if it holds into the close. I do like this reversing candle off the downtrend. And if the market has established that bottom, and starting to move up, this would certainly be a key area of support for OLED.
All right. Next one is going to be Robo, ROBO, and that is Robo Global Robotics and Automation Index, ETF.
Right, you say Robo?
Yep, ROBO.
Okay. Yeah, I mean, we're seeing a lot. We're going to see a lot of the same. And as Aaron showed you with the correlation, a lot of them are highly correlated over the last 20 days with the S&P. So we're going to be looking at a lot of charts that look very, very familiar and similar. I think here, the recent lows are going to be the area I'd watch really closely on support. So you got a low back in November and then another couple of lows in December, right at about 40. You see we did reverse off of that 40.5 level. So we got close to that support level, started to find some buyers. So I think that's a good sign. I think in the near term, the top here, we broke below a support level. And this is what I was talking about the last couple of days. It's like technical analysis doesn't even matter. We lost the 20-day moving average. We lost 50-day moving average. We lost price support in the span of about, 2 days, but certainly just a couple hours yesterday afternoon. But this reversal, to me, it looks like it's maybe in a short-term range between about 40 and 42.5. So I'm okay with it, but with it being in the upper end of that range short-term, I don't know, maybe suspicious at best. I'm again, going to be a little bit more cautious and negative, just given the higher volatility that's out there right now.
Okay. Let's see. Next one, Starbucks. I think you know that symbol.
Yeah, I've been there a couple of times. The key here, I think, and this one is down close to support, but again, it's been on heavy volume, and if the market sells off and volatility picks up later today, we can probably throw support levels out the window. But there is a pretty critical area based on the low that we saw back in August, and then we had multiple lows that came down close to around 53.25 or so. So I'm going to say 52.5 to 53.5 is an area of some support going back several months. And you can see that we did see some buyers come in as we got to a low of 53.5 earlier today, but we're well off the earlier high. We're leaving a pretty long tail to the upside. So the strength just doesn't seem to last in Starbucks right now, and the volumes have been weak. I'd be holding off. I think you'll probably get a better shot at it a little cheaper. All
right. Let's see. Number 4. This one was one that wasn't as correlated, if I recall, to the S&P 500. ARTX.
It's just been kind of going sideways here. Looking at it, the volume tends to be around 200,000 shares or lower. So it's probably one that from a liquidity perspective or standpoint, I'd probably avoid it. It's on the borderline for me. Gap support coming across is 3.5, and you can see we've tested that multiple times without closing below it. So without a doubt, that is a level I will be watching to the downside. A close below 350, and I'd be out.
Okay. Next one I have for you. Let's see. Number 5 will be FINL, Finish Line.
Yeah, it's in the retail space, and this one really has kind of, I don't know, it's been a little bit of a surprise because I thought the retail number 1 would hold up, and so far it's trying to. The XRT is trying to hold its rising 20-week moving average, but some of the individual retailers have lost some key support levels, and I would certainly categorize Finish Line as one of those stocks. I think we had some really good gap support, and we also had some really nice price support. After a huge move up with earnings, you can see that we pulled back to about 12.5. Bottom of gap supports looks like around 1160 or so, and we went right through that. That was before all the selling hit, and then of course we've had the selling on top of it. So far, if we can finish above where we are right now, we could print a bullish engulfing candle, but I don't really see anything else on the chart. You know, if it was at one of these key support levels, I'd feel better about a reversing candle. But I'm thinking that maybe we're still going to see a little bit of weakness down to the recent low in November, maybe as low as 875 or so. So I see mixed signals here. If I was going to get into retail, I'd be more tempted to do the ETF just because it's less risk than trying to catch the right individual stocks. So I'm just going to say avoid FINL for now and maybe just look at the ETF, something like the XRT.
Okay. Let's see. The next one we have is Kratos, KTOS.
I think this is a defense stock.
Indeed.
It was doing much better back in the third and fourth quarters of last year, then kind of fell apart in the fourth quarter, toward the end of the fourth quarter, and we're trying to move back up, but the trend line's been lost. Let's take a look at the trend line here. We had some lows that were kind of holding. Seemed like maybe we're in a little bit of a channel, and that got broken yesterday on some pretty heavy volume. Now the only thing I'm looking at is the price support that was established back at just before the Thanksgiving holiday. So I'm going to say $10 or just beneath $10 is pretty key support. We're sitting at 10.43 right now, recent high of 12. So you could play that trading range, but if the market falls apart and we lose that $10 area or $9.95, I would definitely be out, especially if that volume picks up.
Okay. Let's see, the next one is going to be SPGI, S&P Global. Interesting price movement yesterday to today.
Wow. Huge volume to the downside, big volume back to the upside. It did hold on to a price support level, so I'll give it credit there when a lot of other stocks were struggling. You can see the breakout there, but there was another breakout here that it failed to hold, and it's come right back up. The problem is, here you can see SPGI bouncing back really nicely, which I think is bullish. But so many other stocks have broken down, and we're not seeing this kind of a rally back up, and that's why the market overall can't get going. So trying to pinpoint which one of these stocks is going to make this kind of recovery is the hard part. And so, again, for me, it's about managing risk and staying on the sidelines. Having said that, I do like what's going on here. I think if we can break the trend line to the downside, and I'll just draw that on here, the short-term downtrend. So something like that. The recent highs, if we could break that back to the upside, I think that would be a start. But we may simply roll over after testing this downtrend line and start moving back down toward a key support area. 165 is a major support level, I would say, at this point, especially given the volume and the reversal there.
All right. In the industrial waste and disposal industry, SRCL, Stericycle.
All right, SRCL, another one that lost trendline support. And this is what I was talking about. It seems like technically the key areas of support, whether it's trendline, moving average, price, the market, when it gets in that funk and we see the volatility spike, stocks just start losing key support without any regard for them, really. It's trying to hold on to the recent lows, so I would draw all this in there as well. We've already lost trendline support, so I really don't want to lose that price support. You could go back really over the last 6 months and see that this is an area that has been pretty strong on this chart multiple times. And we're trying to hold it here. I think if we close below the 50-day moving average, I would have to ditch this one and look for something else or just simply sit in cash.
Okay, so let's see. The next one we have after that would be, where is it? Let's do Walmart at WMT.
All right, Walmart is actually in one of those areas. It's in consumer discretionary space and continues to do pretty well, I think, on a relative basis. The daily chart, of course, doesn't look great, but not too many daily charts look good right now. But the weekly chart, I'll annotate the daily, but we could go out to a weekly chart, and you can see we are still staying above that rising 20-week moving average. So technically, from a longer-term perspective, I think Walmart looks very good. Looking at the daily chart, where could it go to? I think you've got great gap support down at the 94 area, just above 94. So that is a level that if it got down to, and you're a fan of Walmart looking for entry, I think that would be pretty interesting because it also would coincide with a 20-week test or be pretty close to one. So that would be an interesting, level for Walmart.
All right, final one, Lockheed Martin, LMT.
All right, LMT. It's in a space, actually, this particular area continues to do well and has done well for many, many years. It seems like every time it pulls back, it's a great opportunity. So I'm going to say that this one does well going forward. I think a couple of key areas, you can see a top back in I guess this was mid-December. We broke out on increasing volume. We've never gone back and tested that level. And then prior to that, there were multiple tops down around 320. So I'm going to say 320 to 325 is a really significant area of support. I'm not going to draw the trend line, but I think you can see a trend line probably comes in right at about that zone as well. So yes, the breakout recently was lost, as just about every breakout's been lost over the last couple of days. But I do think that there is a key price support just a little bit below where the stock currently trades. I think this one remains in an uptrend, and I'm okay, especially on further weakness. I think 320, 325 level would be very interesting for an entry.
All right. That completes 10 and 10. And we should see that chart with the ones that we did today, the symbols, and those will be up in our Market Watchers Live chart list later today with all of those annotations for you. So with that, it's time for our final market update. Let's get a look at what's been going on so far since we went on the air. All right, here we go. So this is the candle glance, and I'm going to actually change this into Canada there for our friends there. All right. So as we can see, it was a difficult morning. We continued that decline down. But since then, even the Dow managed to get into some positive territory. Currently, it's down 26 points. But we can see it looks like we're finally consolidating a little, maybe taking a pause in this difficult decline. And S&P 500, same. You can see most of them mostly unchanged right now after having a somewhat volatile day so far, back up and down above yesterday's close. And we see Russell 2000 down slightly. We could see Canada also difficult morning. And now we are starting to see some consolidation, but just under yesterday's close. Treasury yields are currently down, reading at 27.66. UUP, big gap up, and now we're seeing a major pullback here on the dollar. And we're still in positive territory. We're still a bit higher, but lost a lot of the gains from earlier today. Commodities are mostly unchanged, traveling in negative territory, whereas we have USO had a bit of a decline in the morning, but it's now staying in positive territory, congregating just above yesterday's close, currently reading 1278. GLD has been traveling lower. Looks like we tried to make a little bit of a comeback here midday, but gold GLD falling back off again, currently reading around 126. And we see volatility index, and this is crazy though to see these high numbers. Right now, we peaked today just over 45, but currently the VIX is reading about 37.5, which is still very, very elevated from what we've been seeing with 9s and 10s and 11s previously. So a lot of concern out there. And we can see that advances are leading declines at this point in time. I'm going to go very quickly. We'll look at our market summary and see where our sectors and industries are falling currently. There we go. Get a little percent change there. All right, sector spiders, materials and consumer discretionary are in the top. Consumer discretionary, typically more of an aggressive sector, with the defensive sector, of course, the staples sector. And we're seeing, though, that discretionary is higher, technology as well. And these are all mostly aggressive sectors. So I think that there is a little positive for us there. Utilities down over 2.5% for XLU. As far as our industry groups are concerned, retailers and semis are the leaders, as well as chemicals, all up over 1%. And utilities and insurance are the laggards currently. So with that, I'm going to finish that market update, and I think we'll go ahead and get into our agree, disagree statement and see what everybody thinks and what we each think. And again, Tom and I come up with the statement, but we don't actually discuss beforehand what we think to each other. So it's always interesting to get the various perspectives. I think this is the hugest concern right now. So I figured we would do an agree or disagree with this statement. Last week's selling is the beginning of a bear market. So do you agree or disagree with that? Do you think that we're looking at the beginning of that big market top and we're going to see even more selling? Or are we did we just have this pause, this correction? We've corrected now, and it's time to go back onto the bull market rally. So we will take your thoughts on that. And our producer, I think, is going to be in the background looking at your answers for that. So agree or disagree, is this the beginning of a new bear market? And Tom, I know I have my screen is ready to go, but
go ahead.
Do you want me to do this? Okay.
Go ahead.
Let me go ahead and do that. Hold on. As I say that I have everything ready. All right. Okay. So I'm going to go over to my Safari because I wanted to look at, let's see, I think, I did put them in here. So what I want to look at are my charts for the S&P currently and where we're looking. And I'll tell you right now that, in fact, Carl sent me an email right after I did my decision point DP bulletin yesterday because we had quite a few changes. In fact, I'm going to go show you that right now. So as far as the decision point bulletin, we're getting all of these new scoreboard changes, etc. And what I wanted to point out at this point as to whether this is a new or a new bear market or just a pause. I'm looking at these scoreboards, and right now, of course, they're telling us that there's only short-term issues. And I think this is more of a temperature gauge. I don't think that this is telling us what's happening right now in the short term. And I don't know that that's necessarily what's going to continue happening in the short term. But anyway, after I wrote this article, Carl sent me an email and he says, I just want you to know that I'm looking for a short-term bounce, but that this is he didn't say probably. He said, I think this is the beginning of, I am thinking this is the beginning of a new bear market. So you have Carl's thoughts. And I have to say, Carl and I are usually pretty much on track. And I will have to say that I agree that I'm not going to say I'm clearly, yes, this is the beginning of a new bear market. But as far as what I'm seeing, I think this very well could be. I'm leaning that direction. So for the agree or disagree, I'm going to say, yes, I do believe this is the beginning of a new bear market. But as we've talked about, they go quickly, especially when you're falling out of a parabolic formation. Obviously, we've already lost quite a bit. So let me go and show you. Let's see. And see, I said I had my screen all ready to go, and now I haven't found where I put my chart. So I'll just go over in here. So let's look at the S&P daily. Okay, so we looked at that, and we're seeing the bottom. We're now hitting an area where I think we'll find support in the short term. But the question is, where are we going to go after that if this is truly the beginning of a new bear market phase? And we did a little bit of stair stepping on the way down, although they were really large steps. But we've seen along the way how we stop, pause. And so I think with that gives us some really good levels to watch as far as a bottom. But if you're talking about a serious bear market getting ready to come up, I think we're going to see that bounce. For sure. This is really oversold territory here, and that VIX in the 35-40 range, I think that really tells us to look for that short-term bounce. But over the longer haul, I'm finally seeing this top in overbought territory on the PMO. And granted, this is only a 2-week top. It's only been in play for 2 weeks, and we've seen similar kinds of action. But I really don't like the way that looks, and so that's giving me some pause. But I think we're okay in the short term. We are going to see a bounce, and this is why I say that is this chart screams bounce. Look at my short-term indicators, the Swinland trading oscillators. We're hitting a point, and I believe I turned this into, let's see, a 2-year chart, but I'm going to move this even to a 3-year chart. Here we go. Look at these readings. And when do we get these readings? When have we had these readings? Well, I'm only seeing a few times that we did. And they came, this is what I'm seeing. They came on that first bottom in these particular formations with these double bottoms. And I'm seeing the same sort of setup. I would look for a bounce, but then we're going to probably fall back down. Now, whether we hold the previous low right here, if we bounce and come back and hold that would be great. But I'm not so sure we're going to do that, mainly because we've been in a parabolic move, not just a gentle rise. So that's what I'm looking at. I'm going to say that I agree that this is more than likely the beginning of a new bear market phase.
Okay.
Yeah, so do you agree or disagree?
I completely 250% disagree.
Disagree. All right. See?
I do not think this is the start of a bear market. I think that this is a pullback, a much needed pullback. And yes, it's scary. Market hasn't seen this kind of a pullback in a while. There were a lot of folks thinking the market couldn't go down. I think we needed this, and we're going to need to, wring out the weak hands, those that bought at the top. That it's going to be a process. I think we're coming off a very significant rally uptrend, and so what I expect off of this recent high is some sort of continuation pattern to evolve. Mm-hmm. And I think it's too early to tell what that is. It could be an inverse head and shoulder. It could be a cup with handle. It could be an ascending triangle. But I look for something to develop over the next couple of months that will, and maybe even as long as over the summer, that I think will launch us into another significant rally into the end of the year. So I am going to completely disagree. Now, the chart that I wanted to bring up, let me see if I can bring this up. And first of all, this can be a long-term chart. Going back really the last couple of decades. Let me see if I can pull this up. Here we go. All right, first of all, a top in the stock market doesn't just happen one day. It's a process. And you've got to give those smart money folks an opportunity to rotate their stocks into more defensive areas or out of the stock market completely. Very rarely do bear markets, if you go back and you look at the bear market that started in 2000 and you look at the bear market that started in 2007, the tops, and I'm just going to show here the 2007, which is showing on this chart. You can see that as we got to the top, the XLY, XLP ratio that I like to follow was declining steadily throughout 2007, broke to multi-year lows before we really started seeing any damage whatsoever on the S&P 500. I think that, because we did go up with hardly any pause of late, I think we needed a pullback. I think we're getting it. I think there's panic. I think once the panic settles down, we'll establish a bottom, or at least a short-term bottom. Maybe rally. We might go down one more time over the summer for another low, but I do eventually think that we are going to print some sort of a continuation pattern and move higher. Now, the reason I say this is look at the XLY, XLP ratio now, moving straight up. Money is rotating, has been rotating over the past year and a half into very aggressive areas within consumer stocks and has been avoiding the more defensive areas. That is not normally associated with a stock market top. Transports versus utilities, also breaking to new all-time highs, not generally associated with a stock market top. You look at the aggressive sectors, technology relative to the S&P 500 continuing to rise. XLI relative to the S&P 500 moving higher. The XLY just broke out to an all-time relative high. And financials, after being in the dumps since 2009, literally just hit a decade high on a relative basis to the S&P 500. Those are your four aggressive areas which continue to outperform the S&P 500. Now, I'm not guaranteeing anything because obviously bear markets can be whatever they are. I mean, just because last bear market or last two bear markets or last five bear markets start a certain way doesn't mean that this one can't start a different way. So I'm certainly not trying to, forecast some sort of a guarantee that the market's going to be higher in time. And I do think that right now there is tremendous risk in the market because we have gone up. I would actually disagree with you that it's a parabolic. Because again, I think if you're looking at it on a log scale, which takes into account percentage gains rather than point gains, I think that the move to the upside here over the last couple of years is not much different than we saw in 2012, 13, 14, as far as the angle going up, percentage. And the same thing with 2004. Maybe this one wasn't probably quite as robust to the upside. But I think when you're looking at it on a log scale, have we gone up without a pullback? Yes. But as far as parabolic, to me, I always think of parabolic being a stock that's been trading for, $6, $7, and all of a sudden it's $42 in, 3 weeks. I don't see that with the S&P 500. I think that there are legitimate fundamental reasons why the market has accelerated to the upside, namely the earnings. I mean, I think we've seen that throughout much of earnings season is that many of these companies are blowing away earnings estimates. And as a result, you come up with different valuations on what the market's worth. So I think based on these relative ratios that the under the surface signal, I think the higher VIX is definitely one puzzle piece of a bear market. Bear markets don't exist without elevated VIX. So that is one puzzle piece. But I don't think we can put together one puzzle piece and say that we've got the 1,000-piece jigsaw puzzle put together. I think that the volatility is up there because folks aren't used to seeing selling. It's been a while. The selling is just kind of accelerated. I would not be surprised to see another big sell-off this afternoon, to be honest. The fact that the VIX is still sitting up at 38 or 40 or wherever it is right now bothers me. I just am not anytime the VIX is elevated, to me, it's just screaming that there's substantial risk in the stock market, and that makes me want to just sit in cash. So I'm not good enough to find the exact intraday bottoms and tops. I mean, yeah, there's a lot of money to be made if you can catch it exactly right on both the top and the bottom. But as you can see, and as you saw yesterday afternoon, it can get pretty scary if you don't time it right.
Yeah.
So I just sit it out. But I do think that based on the chart that I just showed, I think that the pieces just don't seem to be in place to me for this to be an ultimate high heading into a bear market. Now, could we go down and then over the summer come back up and have all of a sudden on that rally attempt, money moving into defensive areas? Yeah, I mean, things can change. But based on what I'm looking at right now, I do not believe that this is the beginning of a bear market.
Oh, I will throw in, if everybody remembers, though, remember when Tom McClellan came on? He was looking March, April. This is already a little bit early. We'll have to see. I hate going in, I think with both of us, it is too early, really. But for the sake of everybody getting worried, what are we looking at here? And I am concerned. I'm not going to lie. I really am. And I was feeling that way even before Carl sent me that email. But I think a lot of what he's pretty good. And I know he's been around a lot longer than me. So when he starts to get worried like this, but I will say he's never been a perma bull. If anything, he's always leaned a little bit more to the bearish side. So just food for thought there. But
I did like
question.
Yeah, I did like one of the comments in the room I saw while you were giving your spiel. Someone commented that they disagreed, but that probably means that the top is in.
Yeah, right.
That's the way we all feel. Sometimes it's like, okay, well, if I think it's this, then it's probably going to be the other.
Yeah, absolutely. And I mean, this could just be the fact that, we've had the last, I don't know, year or so, this amazing run up. And this is what happens when you get those almost straight up moves, is when it fails, it's going to fail, and it's going to fail big time, and it's going to be quick, which is why, you always obviously want to have, stops in play and know what you're looking at. But I think my indicators are telling me short term, let's get that bounce. But I think my intermediate term ones are telling me let's be concerned here. We could be looking at the top. So,
all right. Well, let's I guess get into our announcements, and then we can wrap this show up.
Absolutely. So Gordon Scott's going to be here tomorrow from Investopedia. And you'll also get to see on Thursday, Arthur Hill be coming in to give us a short segment. And I think he's actually going to be talking about the VIX. So more discussion about the VIX. We're seeing some interesting action on it. So I think the more discussion, the better.
Yeah, and also I will be doing a workshop. We haven't put it on the schedule yet. I'm going to do one on Friday. I tell you what, though, in today's survey, if you'd like, because I haven't picked a topic, if there's a particular topic that you're interested in, put it in there in the survey response, and maybe I'll be able to pick one from our survey responses today. If you're wondering how to find the survey, lower right-hand part of your screen, how'd we do, you'll see on there. You just click on that link. It's a very brief one-question survey. We just like to hear what you think of Market Watchers Live. But go ahead and put in there if there's a topic that you'd like me to talk about. You know, probably just a 15, 20-minute discussion on Friday. I'd be happy to take a look at that. And with that, I just want to thank everybody again for stopping by. I know it's a nerve-wracking time out there in the market. We're trying to walk you through it as best as we can, but I tell you, it's not easy on our side either. As a reminder, Market Watchers Live airs 5 days a week, Mondays through Fridays, from noon to 1:30 p.m. Eastern Standard Time. Have a great Tuesday afternoon, everybody. We'll see you back here on Wednesday. Happy trading.